Let's start off with the briefing room. That's going to be our first segment here. And the office market isn't recovering like past downturns. And I think we all know why, but it's undergoing a permanent structural transformation right now. Vacancy rates are up over 20%. There's about $1 trillion of commercial real estate debt rolling off the books. AI is changing the way we work, eliminating jobs potentially. So not your dad's real estate cycle. So first chart up we're going to show here is U.S. office vacancy rate. So this is one measurement of this from CoStar. This doesn't show as bad as 20%. This is more across the United States at 14%. Some metros are doing a lot better than others. But as you see this chart up and to the right, and that's an office vacancy rate, not the kind of chart you want to see go up and to the right.
Yeah, what's interesting is obviously during COVID, there's obvious reasons why the vacancy rate went up, and that kind of flattened, but then it went up again, which shows that maybe we have more than just a cycle, as you said.
Yeah, and I think this time is different. Is that the question? Because as you go back, you have the 08-09 crisis, so vacancies went up because a lot of companies were literally going out of business or they're just cutting any expense they could. So the economy recovered, then people fly back to the offices, and so that was kind of the traditional playbook. Now, the economy has been growing since we've come out of COVID, but the remote and hybrid work isn't temporary. I know we're in that bucket that, we're a virtual company. And even for our local team, it's completely optional if and when you want to come into the office. And so one stat here from HQO data is that over 50% of white collar workers now lack an assigned desk. So that means that half of all of them, they may be able to go into an office space, but it's just a flex office space, right? You just plug your laptop down and you get to work. And then the last thing, and I'll get your thoughts here, is the debt maturity wall. So chart up on this one, this says office delinquency rate for mortgages converted into commercial mortgage-backed securities. So really high mountains here is bad. And you can see we had high mountains coming out of the 08-09 financial crisis. Things were looking really good. And then mountains coming out of COVID. And this, again, is just those who have been lending money to office space builders and developers struggling here. So almost $1 trillion of exposure.
Wow. Yeah, there's a lot of headwind, as we said earlier, to the office vacancy rate, everything else. There are problems there. I think going forward, I don't think we're going to go back. I think there's going to be this working remote thing because the technology supports it. A lot of people prefer it. And to be in a job market to get talent, I think it's one of the ways you can attract talent. I think to increase or decrease vacancies, improve the whole office thing, it's going to take some creativity. And that's what we see like with Jamie Dimon, where he's requiring all his employees to come back to the $3 billion building in Manhattan that he built. But if you look at that building, there's incredible amenities. There's things that you can't get working out of your house. And I think that's going to be the game for employers, is attracting people back rather than requiring them to come back. Now, I know Jamie said they have to come back, and that's part of it. But I bet a lot of those employees who come back because it's mandated will actually find themselves happy that they did. But doing the old office space where people have to come in and work out of an office, I believe that ship has sailed and is not coming back.
Yeah, you are spot on. And there's actually data here that I have that shows that prime offices, which are called Class A offices, like that's what we've got, the vacancy is 5% below market average versus Class B or C. So the market is bifurcating. If you've got really nice office space, you need to have the amenities. And like you said, you need to attract talent back. And I know we've talked about, it's like we can't wait for our lease to get rolled off. We got our office sitting about 60% empty on most days. And I can't wait to give it back. And then, maybe we get a really cool flex co-working space that's got a lot of amenities, save some money. And those who want to come in can come in whenever they want, And I think that even as I see the future of our business, I see kind of the same stuff we're seeing in the data here.
Yeah. It reminds me a little bit of what happened with student housing a few years ago, where you had the old dorms like where I stayed when I was in college, and no one wants to stay there because they built up these new places that have amenities. They have a coffee shop, they have a pool, they have a workout facility, all the stuff that you didn't get in the old dorms. And even though they're more expensive, that has been where students want to stay. And I think we're going to see something similar in the office market, is more amenities, more things that attract employees to want to work in the office instead of work from home.
Yep, makes sense. And I think AI, we talked about that, and we got another screenshot here of Amazon targets as many as 30,000 corporate job cuts. So there's uncertainty of what AI is going to do in terms of actual headcount. And a lot of these companies like Walmart, I know, is trying to not really grow their headcount exposure. So that is more headwinds, I should say, for the office space. And some downstream ramifications that's interesting here is the municipal budget. So if you're a city, if you're a state, you generate a substantial amount of revenue from property taxes. And property taxes is based off the fair market value of that office space. So San Francisco, their values are down 50% from the peak. And so San Francisco's got $1 billion bogey in their budget. And again, it's not all because of office spaces, but again, their collections on property taxes down 50% from the peak because office values have plummeted. And then just recently, Washington, D.C., they came out with their budget. They got just under $101 billion of revenue from property taxes last year, and their budget now is projecting $93 billion. So they're going to take about a 7% haircut, and that's just probably the beginning. But translating that to dollars, again, $7 billion now gone from Washington, D.C.'s budget just because of commercial property values declining. And if this doesn't stop, it's going to have a lot of downstream ramifications.
Yeah,
there.
Luckily San Francisco and DC are really good with their finances. They're really smart how they handle things.
Yeah, just like I would say that for probably every single city. So
yeah,
I think for business owners, as an investors, I think it's important to think through, what is your exposure, or if you're looking at investing in commercial real estate, if you're going to do a B project or a C project, there better be line of sight to making that an A project. And I know locally here, there's the Bond building. I don't know if you've been down there off of, I think it's like 24th or 32nd and Camelback, but they completely redid it. They have a spa in there, high end. They got a restaurant. They got a high end gym. It's beautiful. And they completely gutted it. I'm sure they put tens and tens and tens of millions of dollars in there, but now it is, I think, one of the highest per square foot rents in the valley because they've done such a good job flipping that into like a high Class A property.
Yeah, I think the other thing is they're going to have to start trying to figure out how they can use office space for multiple different things, not just for office space. Flex spaces and event spaces and other things like that. I think they're going to have to use those buildings for more than just traditional office space if they're going to fill them.